Hey, if you're a real estate pro and you also own rental properties, listen up, because you might be missing out on a huge tax break. Seriously, the IRS has it kind of locked away, but today we're going to find the key. Let's dive into this really powerful strategy called Real Estate Professional Status, or REP for short. So, let me ask you something. You've got a rental property, right? You run the numbers, you factor in depreciation, and boom, on paper, you've got a loss. And you're thinking, awesome, I can use this to slash the taxes on my commission income. But can you? Really?
Well, for most people, the answer is a big fat no. It's crazy, right? Those valuable losses are basically trapped. They're just stuck. They can't help you. And it's all because of these pesky things called the passive loss rules. This is the default setting, the standard rule for pretty much everyone who owns a rental.
All right, so let's dive into Section 1, the real estate tax trap. We're going to talk about why your losses often don't count. Let's really unpack what this trap is, because it's a huge deal. It literally stops thousands of investors from getting the full tax benefits they think they're entitled to every single year.
Okay, so here's the absolute core of the problem. Just imagine the IRS puts your money into two different buckets. In one bucket, you've got your active income. That's the money you earn from your job, like your real estate commissions. But in the other bucket, you've got your passive income, or in this case, your passive loss from that rental property. And here's the rule, and it's a simple one. Passive losses can only be used against passive gains. They can't jump over to that other bucket and lower your active income. They are totally stuck.
But what if you could change the rules of the game? What if you could literally take those rental losses and move them from the passive bucket over to the active bucket? Well, guess what? You can. And this is exactly where real estate professional status comes in. It is the key. It's how you unlock that trap.
So, what exactly is this rep status? Well, it's an official designation from the IRS, but I want you to think of it less like a fancy title and more like a super powerful tax classification. Basically, you're telling the IRS, hey, my rental activities aren't just some passive side hobby. This is an active part of my business. And believe me, that one little shift changes absolutely everything. Okay, this slide right here, this is the big aha moment. Think about it. Before you have rep status, there's a brick wall between your active income and your passive losses. They can't touch. But once you get rep status, you get to smash down that wall. All of a sudden, those rental losses can flow right over and directly lower your commission income. And get this, they can even offset your spouse's W-2 income if you file a joint tax return. Suddenly, depreciation stops being just some number on a spreadsheet and becomes this incredible tool for slashing your tax bill. It's a game changer.
All right, Section 3, the 2 IRS tests, or proving you're a professional. I mean, this all sounds pretty amazing, right? So the next logical question is, how do you get this status? Well, it's not automatic. And it has nothing to do with having a real estate license. You actually have to prove it to the IRS by passing 2 very specific tests. Let's break them down.
All right, test number 1, part 1. It's a numbers game, plain and simple. You have to spend a minimum of 750 hours a year working in real estate trades or businesses. To put that in perspective, that's about 15 hours a week, every week. But wait, there's a catch. That's just part 1. Part 2 is that those 750 hours also have to be more than half, so greater than 50%, of all your working time for the whole year. So let's be real, if you've got another full-time W-2 job that has nothing to do with real estate, passing this part of the test is going to be extremely difficult, if not impossible.
So you're probably wondering, what kind of work actually counts towards those hours? Well, here's the good news for all you agents and brokers out there. Your core job activities. We're talking showings, contracts, marketing, all that stuff, it all counts. So does any hands-on property management, leasing work, renovations you're involved in. Now what doesn't count? Passive stuff. You can't count just reviewing a monthly statement or the hours your property manager is putting in. The key word here is your time. You have to be the one doing the work.
Okay, so let's say you've passed that big time test, the 750 hours and the more than 50% rule. Great, but you're not done yet. There is a second, equally critical test. You also have to prove that you materially participate in your own rental properties. See, it's not enough to just be a busy real estate agent. You also have to prove you're a hands-on landlord for your own stuff.
So how do you prove this material participation? Well, it really boils down to tracking your time and your effort. The IRS gives you a few ways to do it. The most common one is spending over 500 hours a year just on your rentals. Or you could show that you do more work on the properties than anyone else, including contractors. And for anyone who has more than one property, there's this fantastic strategy called a grouping election, which lets you combine all your rentals into one single activity. We're going to talk more about that.
Which brings us to our next section, smarter LREP strategies, and how to make this actually work for you. You know, knowing the rules is one thing, but using them strategically is something else entirely. So let's shift gears and look at a few really smart strategies that can make qualifying for LREP status a whole lot easier.
Okay, do you own more than one rental property? Or maybe you're planning to. If that's you, you need to lean in and pay close attention to this next part, because this strategy is absolutely essential.
It's called the grouping election, and it is a lifesaver. Look, trying to prove you materially participate in each and every single property you own is, well, it's pretty much impossible. So instead, you make a formal election on your tax return. You do this with your CPA to treat all your rentals as one single economic activity. And just like that, you can pool all your hours together. That hour you spent on a tenant call for one property and the 2 hours of bookkeeping for another, they all go into the same bucket, making it so much easier to hit a threshold like that 500-hour test for the whole group.
Now, a really quick but super important strategy note here, self-management is key. I mean, it is everything. If you just hand off all your properties to a management company and do nothing but cash the checks, you're going to have a really hard time arguing to the IRS that you're materially participating. You have to be involved in the day-to-day operations and the big decisions.
Oh, and what about short-term rentals? You know, your Airbnbs, your VRBOs. This is a really interesting little loophole. See, if the average stay for your guests is 7 days or less, the IRS might not even consider it a rental activity in the same way. It could be treated as an active business by default. And what does that mean? It means you might be able to get all those great tax benefits, deducting your losses, without even needing to qualify for rep status. It's an incredibly powerful exception, so for sure, talk to your CPA about this one.
All right, on to our next section, protecting yourself from audits, because documentation is everything. Look, we've talked about all the amazing benefits and the smart strategies. Now it's time for the most important warning I can give you. REP status is a major red flag for the IRS. It's a high audit area. So if you're going to claim it, you have to be ready to defend it. And your defense comes down to one single thing: documentation.
I really want you to let this sink in. The IRS is actively, proactively looking for people who claim this status but can't back it up. Trying to recreate a whole year's worth of time logs from memory after you get that scary letter from the IRS? It's a losing strategy. It's a recipe for disaster. You will almost certainly lose the audit.
So here's the solution. It's simple. Your defense has to be built before you ever get questioned. And your best defense, your only real defense, is what's called a contemporaneous time log. That's just a fancy way of saying you track your hours as you go or very shortly after. This log is not just a piece of paper. It is your bulletproof audit protection.
And look, it does not have to be complicated at all. A simple spreadsheet, just like this one, is absolutely perfect. All you need is the date, which property you worked on, what you were doing, a quick little description, and how much time you spent. Seriously, getting into the habit of updating this once a week is a simple little task that could literally save you tens of thousands of dollars if you get audited.
Okay, let's wrap this up with the key takeaways. Number 1, rep status is your key to unlocking some truly significant tax savings. Number 2, you've got to earn it. You have to pass both the time test and the material participation test. Number 3, if you own more than one property, the grouping election isn't just a good idea, it's a critical strategy. Number 4, and maybe the most important, meticulous, real-time documentation is non-negotiable. And finally, please always work with a CPA who really gets rep status. Not all of them do.
So I'll just leave you with this final question. You've earned the income, you've put in the hours, you've dealt with the tenants, you've earned it. The question is, are you ready to do the simple work to prove you've earned the deduction that goes with it?
Are you looking to buy a home in Columbia, Missouri? Call Blue Spruce Realty today.